Bitcoin's supply is fixed. It cannot be inflated. It cannot be changed. Every 4 years, the production of new coins gets cut in half. Nearly 6 million Bitcoin have already been permanently removed from circulation. The coins available on exchanges are at historic lows and still dropping. Wall Street is absorbing Bitcoin at 12 times the daily mining rate. BlackRock alone holds more Bitcoin than most countries on Earth, and governments, including the United States, are now competing to stockpile it. When you feed all of that into a peer-reviewed academic model, the conservative price projection by 2036 is between $1.5 million and $3 million. The data is hiding in plain sight. Let's go through it chart by chart. Nothing in this video is financial advice. Always do your own research. This first chart is the foundation of everything. The dark red line is the stock-to-flow model, a measure of scarcity. It compares Bitcoin's total existing supply to how much new Bitcoin is being created each year. The higher the ratio, the scarcer the asset. The rainbow line is the actual Bitcoin price, colored by how many days remain until the next halving. Look at the pattern across 14 years. The price essentially orbits that model line. It overshoots into euphoria, pulls back, and then the model climbs to meet it again, over and over. Here is what makes Bitcoin different from every other asset. When oil gets expensive, producers drill more. When gold gets expensive, miners mine more. Supply adjusts. Bitcoin cannot do that. Its supply is fixed in code, approximately 450 new coins per day, no matter what price does. That number drops again at every halving. The supply curve does not bend. That single fact is the foundation of everything else we are about to see. Now look at this halving chart. The shaded vertical bands each mark the period following a halving event, when the daily production of new Bitcoin was cut in half. Inside every single band, you see the same thing. Price goes nearly vertical. After the 2012 halving, from single digits to over $1,000. After 2016, from a few hundred to nearly $20,000. After 2020, from $9,000 to nearly $69,000. After April 2024, Bitcoin has already crossed $100,000. 4 halvings, 4 bull runs, every time. Is it just psychology? Partly, but the underlying supply shock is real. Fewer new coins entering a market with growing demand is not a feeling, it is arithmetic. And that brings us to the academic model that formalizes exactly why. This is not a trading chart. This is a figure from a peer-reviewed academic paper published in the Journal of Risk and Financial Management in January 2025 by researchers Rudd and Porter. It maps a formal supply and demand model built specifically for Bitcoin. The top half is demand. It models adoption using a logistic growth curve, the S-curve, how technology spreads from early adopters to the mainstream. The bottom half is supply. It tracks daily new Bitcoin from mining, but also daily withdrawals from liquid supply, coins moving into long-term storage, corporate treasuries, ETF vaults, and government reserves, plus lost Bitcoin that will never move again. Both sides feed into one central variable, liquid supply, the Bitcoin actually available to trade right now. Liquid supply meeting a growing demand curve produces the price output. This is the first model that treats Bitcoin's price not as random sentiment, but as the mathematical outcome of fixed supply meeting growing demand, with shrinking liquid supply as the key mechanism. The next 4 charts show you exactly what is happening to that liquid supply right now. This data comes from Fidelity Digital Assets, not a Bitcoin maximalist, one of the world's largest financial institutions. 2 lines. The orange line is liquid supply, Bitcoin actively circulating on exchanges, available to buy or sell. It hovered flat around 15 million for years. Now look at the right side. It is curving downward, falling to 14 million and declining. The green line is illiquid supply. Bitcoin moved into wallets and never touched again. Long-term holders, cold storage, institutions. That line does nothing but climb from under 1 million in 2016 to nearly 6 million today. 6 million Bitcoin permanently removed from active circulation. The remaining liquid supply is shrinking. The squeeze is not coming. It is already in the data as of June 2025. This coin glass chart shows the most immediate symptom of that squeeze. The teal area is the total Bitcoin sitting across all major exchanges. In early 2024, it was around 3.3 million. Watch what happens. It descends steadily, week after week. By early 2026, it has fallen below 2.5 million. Hundreds of thousands of coins drained off exchanges in 2 years. Meanwhile, the gold price line climbed from $65,000 to above $100,000. Here is the simple logic. Exchanges are where you go to sell Bitcoin. Less Bitcoin on exchanges means less available to sell when new buyers arrive. When demand hits shrinking supply, prices move. Not by opinion, by arithmetic. January 10, 2024, the SEC approved spot Bitcoin ETFs, and this chart tells you exactly what happened. Green bars are daily net inflows into spot Bitcoin ETFs. Red bars are outflows. The green dominates overwhelmingly. More frequent, taller, more sustained. In late 2024, single-day inflows hit $1 billion multiple times. Here is the number that puts it in perspective. ETF flows were absorbing Bitcoin at roughly 12 times the daily mining rate. Miners create 450 coins per day. ETFs were absorbing the equivalent of 12 times that amount. And here is what makes this cycle different from 2017 or 2021. When retail buyers bought Bitcoin and it got volatile, they sold. Institutions do not behave that way. Their Bitcoin goes into custodians, cold vaults, balance sheets. It does not come back to exchanges. Every ETF inflow is functionally another permanent transfer from liquid to illiquid supply. This table from bitcointreasuries.net looks simple. It is not. Row 1, BlackRock's iShares Bitcoin Trust, 764,431 Bitcoin, $51 billion, 3.64% of all Bitcoin that will ever be existent. One product, one firm. Row 2, Fidelity, 187,813 Bitcoin. Row 3, Grayscale, 167,683 Bitcoin. Add the top 6 together, over 1.2 million Bitcoin held by institutional vehicles that are accumulating, not selling. Look at the spark lines next to each number. BlackRock's curves upward continuously. Fidelity's does the same. These are active accumulation curves. Think of it this way. There are 21,000 collectible items in existence, forever. BlackRock just bought 764 of them and adds more every week. This Chainalysis report from May 2025 is titled Bitcoin Strategic Reserves, Behind the Changing Architecture of Sovereign Finance. Sovereign finance, nation states. In early 2025, the United States signed an executive order establishing a strategic Bitcoin reserve, approximately 198,000 coins held as a long-term national asset in the same category as gold, not to be sold. China holds an estimated 190,000 Bitcoin. The UK holds around 62,000. Bhutan has been quietly mining with hydroelectric power and holds over 10,000. El Salvador maintains its national position. When a government designates Bitcoin as a strategic reserve, it has no stop-loss order. It will not sell during a 30% correction. Those coins are gone from liquid supply permanently. And if multiple sovereign nations decide to grow their positions simultaneously, no amount of new mining can offset that contraction. This is Figure 10 from the Rudd and Porter paper, a 12-year price forecast from April 2024 to April 2036. 4 scenarios, each one varying only the daily rate at which Bitcoin is being permanently withdrawn from liquid supply. Scenario 1000, the most conservative, 1,000 Bitcoin removed per day. By 2036, 1.5 million. Scenario 2000, 2.3 million by 2036. Scenario 3000 crosses 3 million before 2036. Scenario 4000 reaches 3 million by 2031, 5 years earlier. Now ask yourself honestly, which scenario are we already in? ETFs absorbing at 12 times the mining rate, corporate treasuries growing every quarter, sovereign reserves being locked away, long-term holder behavior expanding since 2016. The daily withdrawal rate is almost certainly not sitting at the most conservative end of this model. I want to be honest with you. This model is not a guarantee. It assumes demand keeps growing, no catastrophic regulation, and Bitcoin's network keeps functioning. Those are reasonable assumptions, but they are still assumptions. Financial markets have surprised everyone before. What this model gives you is not certainty. It gives you structure, a framework grounded in supply and demand mechanics, not emotion, not cycle timing, not hope. 9 charts, 1 connected story. Fixed supply, shrinking liquid supply, exchanges draining of inventory, ETFs absorbing at 12 times the mining rate, institutions holding over 1 million coins, governments establishing national reserves, and a peer-reviewed model pointing to $1.5 million to $3 million by 2036. The structural forces are real, they are measurable, and they are accelerating. As always, nothing here is financial advice. Do your own research, never invest more than you can afford to lose. The data is yours to interpret. If this video gave you value, hit like and subscribe. I break down data like this every single week, and you do not want to miss what is coming next.